Welcome back to the Entry Level Trading course by Valetax. My name is Ryan Ifere and I am your educator for this course. This is episode 9. And on this episode, we're going to be discussing risk management and how traders survive. Now, this is very important for each and every beginner trader to understand before moving into the next phase of their trading journey, which makes them intermediate traders. So let's move forward. Please stay tuned. Why most accounts get blown and why risk matters more than winning. You can be wrong many times and still be profitable if your risk is controlled. Survival is more important than being right when it comes to the market. And why is survival more important than being right when it comes to the market? Because the market is an anarchy. The market is a chaotic place. The market is an avenue of millions and billions of people exchanging prices. So there is no law, there is no regulation that manages the emotions of traders in this market. So the reason why it's important to focus more on the risk than just winning is because you need to first protect yourself before you think about winning. And that is why I say the market is survival. Now, why most accounts blow is not because of strategy failure or risk management failure or one bad trade. The reason why a lot of accounts get blown is a lack of proper risk management. Even professional traders lose accounts when they fail to abide by their own personal rules and principles and fail to do the necessary risk assessment and management in check. So, what then should we risk per trade? So, when we talk about risk per trade, we first need to understand the size of capital and available liquidity. A percentage of your account you can lose is what you should risk per trade. And our advice is for beginners to risk anywhere between 0.5% or 1% per trade of their accounts to keep their emotions stable and in check while they are in their learning curve. Because the more you expose your account, be it demo or a small account you're trying to trade as a trader, the more emotional turmoil you have to go through. So it's important that you manage your risks properly so that you enjoy the gravity of your trades and understand your trades better and build an edge better than just trying to see more blue screens as usual. So you want to focus more on risking a percentage of your account you can lose. So if it's 5% you're okay with losing on your account, then you should risk 5% on your trades. Now, when we say risk 0.5% to 1% per trade, we're not talking of each position. We're talking about a particular asset being traded. So you could be trading an asset and have 5 positions open on that asset. Those 5 positions cumulatively should be around 0.5% to 1%, or the desired percentage of your account you are accommodating to let go of. Position sizing. Okay, just a very simple position sizing calculation that you need. Okay, lot size controls risks, right? So a bigger lot, and this was clearly described in the episode where we spoke about currency pips, currency pairs, and lot sizes. You should refer back to that, episode 3. A bigger lot does not equal to a better trade. Rather, a bigger lot puts you at more risk. So how do you take advantage of this? All you have to do is use a lot size calculator. So when you're about to make an entry, put your lot size and your specific stop loss and you take profit to do a proper calculation of what you would be risking and what you would be targeting to make on that trade. That would further help you understand what percentage of your account that you would be putting in harm's way or be exposing to risk. Lot sizes calculated after stop loss is just a waste of time. So you need to calculate it first before you make that entry. Now, this is more psychological than it is technical right now, what I'm about to explain to you. Winning isn't everything. You can win 40% of the trades and still be profitable. At the end of the day, what is most important is your risk to reward ratio. So if you take 10 trades and you're losing lesser than you're winning, you're going to stay profitable. So for instance, if you take 10 trades at 1:3, so you're risking 1% to make 3%. If you lose 5 of those trades, you would have lost only 5%. And if you win the remaining 5 out of 10, you would have made 15% because 3 times 5 is 15. So you've made 3% in 5 places, that's 15%. And you've lost only 1% in 5 places, that's 5%. So by the time you do an aggregate and you balance the sheet, you're up 10%. That keeps you profitable. So losses are part of the business, and you need to understand this. It's about how much you lose against how much you win. So if you lose less and win more, you stay profitable. But if you lose more and win less, then you're never going to be profitable. And that is how the idea of managing your risks is being calculated. So small losses gives you more survival fuel. So how is the professional mindset for risk management? First, you want to protect capital, and consistency beats excitement. So it's about making gradual steps into your trading. Some days you're going to make losses, but it's fine. For as long as those losses are less and your wins are bigger, even on the days where they are just break even. A break even trade is better than losing excessive. Okay? If you survive long enough, then your skill compounds and your risk can match up and increase. And that is how long-term investors and traders think in the market. And we've come to the end of understanding risk management. I hope that with these few words that I've put to you, you're able to do better when it comes to protecting your capital and making the right choices of trades to take in the market. I'll see you on the next episode. And don't forget to go back to previous episodes to understand how to make better entries and how to set your stop losses and your take profits.